The other day, the Giants officially announced that they're benching Eli Manning for Daniel Jones. So, as a lifelong Giants fan today, I want to start with a moment of silence for Eli Manning. All right, thank you for your respect in this trying time. I don't know if this will be the end of his career, though. He said he wants to come back for the next 2 years and finish his contract.
Yeah, but that kind of depends on like how good his career is.
That's true. They say he's the future.
Take a little star. I don't know what you are. You should mind that. A lot of people rating it up.
Yeah. And in 1 or 2 last semester, I offered that. People show up late all the time, and there's like very few people do it. There'd be like a long, awkward pause. I'd look around. Anyone? Anyone?
I'll be the first. I thought she was going to do it. I'm like, no way. I got this.
Sorry, I'm sure there'll be more chances to do that. It's an 8 a.m.
Scare you.
Didn't know how to react.
How do you react when someone does that to you?
I'm not going to lie. I forgot the words. Maybe we that part.
Also, you'll note I'm wearing more casual clothes today. I'm moving out of my office today and into the library. So from now on,
It's not bad, I guess.
it's not terrible.
Could be worse.
It could be the Small Business Development Center. Max can't do it.
Is there again?
You can't. Anyone else can.
You guys are soft.
One thing I'll say I was a little disappointed. I have this really sweet office over here, and now I'm moving into a room with 3 other people. Employees don't like it when they get, downgraded. They get less respect or fewer perks or less money. Something macroeconomists talk about is the idea of sticky wages, that wages are slow to respond to changes in supply and demand, especially wage decreases. Obviously, no one wants to get their wages cut. They're not going to be happy and they're not going to work well. That was something that's central to like the Keynesian theory of the macroeconomy, which I think is very appropriate. It's a very good insight. We saw this during the last recession. Wages didn't fall, but they stagnated for a long time. And when asked, 4 years into the recovery, why is wage growth so slow? Why is inflation so slow? Janet Yellen responded that we were experiencing what she called pent-up wage deflation, meaning that wages should have fallen due to supply and demand, due to lower productivity or whatever, but they didn't because wages are sticky. Workers don't want their wages cut. So wages didn't grow because they should have been lower. So I don't think there's any markers today. Okay, so wages should have been lower, and they were down. They should have been down here, but they were up here. So you see what should have been like wage increases due to supply and demand, due to greater productivity, increasing over that time, but they're still getting up to where the wages were at that point. So there should have been growth due to an improving economy, due to lower unemployment, but there wasn't because wages were too high. That's something we talked about when I did the Fed challenge, because inflation was super low back then, and that was a huge worry. It still is low, and it's a worry for Fed economists. You guys on the Fed challenge team want to talk quick to the class about the Fed challenge? Ben's first meeting was yesterday.
Yeah, so we had our first meeting. It went decent. We have a decent amount of kids out. It's a great time.
We have 5 presenters, and there were 5 people on the team there.
Yep, which is perfect.
Well, we prefer to have more people in case something happens.
Better than having 4 though.
It beats 4.
Yeah, but no, it's a lot of fun. So we make our own recommendations for monetary policy based on different economic factors going on, and we try to correlate it to what we think the Fed's going to do, what they say they're doing. It's pretty cool. We do the Lehigh. It's just a nice dinner.
Yeah, this year it's going to be at Lehigh University, so it's here in Eastern PA, north of Philly. Kind of a far drive from us over here, but beautiful campus.
You guys will get to see Ilya.
Yeah, Ilya's still there.
Ilya and isn't there there's a girl?
Is it Ji Chen?
Yeah.
Oh, was she at least?
She was there
She's
last
at
year.
Lehigh. I don't know if she's still there. She might have graduated.
I don't know either, but if you're
Yeah.
interested in monetary policy and you think you can cut it up with us, then get on the next meeting.
It's a great way to accompany this class because you're digging deep into trying to understand the state of the economy, what indicators show like the macroeconomy is doing well. So you're not just looking at the unemployment rate, you're looking at like the job openings rate, job turnovers, digging deeper to understand really what's going on. Again, like you don't just look at GDP, you look at durable goods, which shows consumer confidence, not just from like a survey, but it shows like people are actually going out and spending their money on expensive things. They're taking out loans. So they think they're going to keep their job for a while. They think the economy's doing well enough that they can purchase this and not have to worry.
Further, people are very, very impressed with interviews of you talk about monetary policy. You know what that is.
Yeah, and as an economist, I know a lot of you guys aren't going into like the same type of jobs I apply for. They talked about that like for like half my interviews sometimes. The one that talked about the least was, ironically, the Federal Reserve when I applied there. I know.
Tuesdays, 12:15, everyone.
Hey, they were open. Federal Reserve. It's not posted on Twitter.
For what position?
Like a senior analyst.
They're still missing like two like
You need to be a
two
top-
FOMC
12:15,
members. Because there's 5 presenters, we have 5 people interested on the team. You're not guaranteed to get a spot presenting. If you're good and know your stuff, you can step right in on the team because we don't have a lot of returning presenters. But if you're like nervous, you're like, oh, it's my first year, I don't know if I want to present. I was nervous my first year and didn't want to present. Ended up presenting anyway because of people getting kicked off the team for not showing up. Yeah, but if you're like nervous and don't want to, there's no guarantee you're not going to be forced into doing it. It could just be like a nice learning experience to accompany this class.
But if you want to, and you show that you're intelligent and capable, I know a spot can very well.
If you don't make a spot on the presenting team, can you still go to the challenge?
Yeah, they take one off.
Yeah, we take one alternate. Maybe we can get away with 2 if there's just 2 alternates. Probably get away with taking both, especially if you're like an underclassman who could present in the future.
He took us to that really cool restaurant last year.
I forget what that restaurant's called, but yeah, he loves that
Really
place.
good. He got that-
Obviously, everything's paid for, the hotel, the food. But
everything but the beer. You have to buy that on the way.
yeah, St. Francis doesn't pay that, surprisingly.
Speaking of the Fed, what do you think about, they come out today with their report, right?
Is it an FOMC meeting today, or are you talking like the beige book or one of those?
I think it's the minutes, right? No?
I'm not sure. I feel like I should know that since I'm the one up here, but
Right.
it's really cool right now because we don't know what the Fed's gonna do.
Yeah.
During the crisis, it was like,
Big
all right,
bets.
they're gonna keep it at 0 lower bound and they're gonna wait 3 years and to start raising interest rates and start cutting down the portfolio. But now like, we don't know, especially with the pressure that Trump's putting on them,
Yeah.
and Congress is continuing to put pressure on them.
We should make bets and whoever's right.
Well, if they're releasing the
Whoever's
minutes,
right
there's
gets
no new news
$100
coming out. If
Yeah,
it's the new press conference,
It's the new press conference.
Oh, it is?
Today at 2:30.
okay.
Yeah, and they're expected to cut a quarter point to,
I know,
for a
right?
range between 1.7.
That's a bad idea.
They already cut last meeting.
This was already priced in though.
I don't know. This is not the time to be cutting interest rates.
No.
What?
Just wait till the next crisis, and we're like next recession. We have like federal funds rate is like 1.5%.
Yeah.
And we're gonna have no room to go.
Yeah. You know what Jason would say?
Oh,
We give
Jason.
room to go, we give negative.
We gotta go negative every time.
Just drop her down, maybe,
What he says.
see what happens.
Who says that?
Jason Hawkins. Yeah, well, he's a kid. So we have a question. Speaking of negative interest rates, I read somewhere that like, you know, once you hit negative, like you almost can't come back up. I mean, you like physically.
Well, who's gone negative?
Well, Japan's negative right now. They have been for the last like, what, 4
I wouldn't say Japan is a good case study for really anything.
Well, there's like
Because
only
of-
one.
Yeah, because of so many things going on in their economy. Like,
Yeah.
they have the oldest population in the world.
Yeah.
So they have all these demographic issues that are pushing down wages.
We
That,
were really looking at that last
Yeah.
week in our meeting, we were talking about that.
1.44 versus 12 per woman,
Yeah,
which isn't that bad.
no, but they're like, what, population
It's like-
percentage or something?
per,
I
the
was-
percentage of
Mexico
population over
looked at-
60 is
It
huge.
was just like,
I
Yeah.
recommended that we go buy a bunch of houses because they're so cheap over there and wait until.
yeah, Aaron's banking on 20
Wait
years.
until
of
there's a
population.
lot more people, go sell the houses, huge profit. But that's a really, really long-term investment.
No, I just
That
think
could be like a 70-year.
I just read somewhere that like the shock that it would give the economy of bringing it back up to like zero positive interest rates. It just was like too much of a shock.
That's interesting. I've been reading a lot about negative interest rates because we've been raising rates finally. For the
What's
past
his
6
name?
years.
Not Andrew. The guy in the casino.
Nick.
Nick. He, I forget if it was his one or it was a different talk in the Bahamas, but like their whole thing was on negative interest rates. And they said like it works beautifully if you have a cashless economy. But if you have cash.
Oh yeah, if you design a perfect macroeconomic model, you can get it to work.
Yeah. I don't know.
But then suddenly there's frictions in the real economy that even I think a couple countries in Europe went negative.
Do they?
Yeah, increase.
Who's got central banks in Europe? Is it Sweden? Does anyone know? I think Switzerland has their own because they still have their own. The Swiss franc is still their currency, right? Not the euro. I want to say Sweden. One of the Scandinavian countries has their own central bank, and I think they went negative slightly, but all the interest rates for bonds in the rest of the economy, besides the short-term government ones, were still positive. They're just super, super low. I don't know. The Fed has tried, well, they haven't gone negative, but they have tried to lower the yields on longer-term debt. That was like Operation Twist. Typically, they try to push down, in recessions, push down the interest rates on short-term government debt to as low as they have to go. But once they run out of room there, they start looking at longer-term debt. So go to the 5-year, the 10-year.
Apparently there's a bank in Denmark offering a 10-year home loan at an interest rate of negative 0.5% a year. That's wild.
That's crazy.
Yeah.
So you kind of said how there's no more room to cut cutting out. What is your thought behind that?
Well, the thought is that they're not going to go negative. And if they don't go negative, they're stuck at what they call the zero lower bound, where you can take the federal funds rate down to zero. Once you hit there, you're not going to be able to do anything else. So at that point, you run out of policy tools, your conventional policy tools. And that's why the Fed did all that quantitative easing.
Yeah.
They bought non-traditional assets like mortgage-backed securities from Freddie and Fannie, longer-term government debt. What else do they buy weird that's on the balance sheet now?
Oh, the slide on it.
Yeah, I don't have the balance sheet here.
I like the old balance sheet from last year.
Yeah, I forget. There was some other type of asset they bought trying to provide relief to the financial system. That just they can't do anything else to the federal funds rate, so they have to go elsewhere.
So at the highest level, basically, the Fed, they have two main components, right? They can control
What's the
interest
goal
rates,
mandate?
and then the outflow of cash in the markets,
I'm sorry, say the first one again.
the interest rates, they can control interest rates.
Yeah, they do. They influence interest rates and the other tool, the reserve requirements.
Right. So, whenever there is a recession coming, do you think that they ever consider that, in reality, they only have branches off of two poles that they can really use to try and bring money back?
What do you mean? Do they realize that?
why would they be cutting out? Like, I feel like they're almost just like prolonging it.
I mean, that's the question I'm asking. Why are they cutting rates now?
Yeah.
I forget what Powell said last time. I guess headwinds from the uncertainty regarding trade policy is going to put downward pressure on GDP. The threat of an escalating trade war, again, downward pressure on GDP. People keep saying there's concerns of recession for like this reason or that reason, but they don't seem to be really good reasons for a recession, just like, oh, we're out of growth because it's been long enough.
Yeah. Did you see the headline yesterday about like the liquidity? I think they probably $700 something.
No.
On that, I like didn't understand it at all. It was like, I don't know.
They sold up on they really say what they're on there. Like, I'm looking at those that are on the balance sheet. The total assets, securities held outright, all liquidity facilities, and support for specific institutions.
Okay. If you were old enough, I would have been old enough in 2010 and listening to the Federal Reserve right after the stock market crashed. So like the S&P 500 loses like, I don't know, like 38% of its value. At Jackson Hole, Ben Bernanke says, one of the goals of quantitative easing was to support asset prices in order to like help spur on the recovery. The idea was the wealth effect, that if people see their portfolios increase for like their retirement or whatever, they're gonna feel like they have more money, so they'll be more willing to spend it, more willing to consume. Had you known that, you said, oh, he's gonna support the stock market. Let's buy some stocks now. And over the next year, it jumped back up like 35%, and then like 10% the next year. Even though the economy was still really struggling, asset prices were shooting up. I thought of that when Max said the support to specific institutions.
Yeah, with that, without those, you would. If you go, look at assets. Support to specific institutions include Maiden Lane LLC, Maiden Lane 2 LLC, Maiden Lane 3 LLC, and support to AIG.
Oh yeah, those are toxic assets they bought during the crisis in order for certain banks to merge together. I don't remember off the top of my head who was in trouble. Was it B of A that had, no, Wells Fargo? Like Wells Fargo had like all these toxic assets, so B of A didn't want to buy them because how much money they'd lose from that. So the Fed bought it from them, spun it off into what they call Maiden Lane, which is a portfolio of just crap that's never going to pay them back.
And the support to AIG includes credit extended to the American International Group of Preferred Interest in AIA, Aurora LLC, and Alico LLC.
All right, we'll have to save this for later when we talk about the financial crisis, because that's specifics of like what the Fed actually did. But we need to talk about what the Fed is first and like what their tools are in detail, to like start to understand that. So hopefully I can power through this in like 1 or like 1.5 classes of the structure of the Fed. It's very weird compared to other central banks because it came about due to the certain political notions that are inherent in America that other countries don't have to deal with, namely our distrust and hatred of banks. So we're going to dig into more detail in this in Money, Free, and Unfree. But for years, the United States had, well, for like centuries, resistance to the establishment of a central bank. There was a fear of centralized power. So we see this in the Constitution. We split up the government into 3 equal branches that all had checks and balances over each other. And we had multiple layers. So we had, especially originally, the states had pretty much all the power. They would pass pretty much like all the laws. And the federal government would just regulate stuff that happened between states. So, you know, like crimes that happen across state lines, or stuff for all states dealing with other countries. Everything else was handled in the states, including like banking. There was also a distrust of moneyed interests. That was like the term they used back then for either like speculators, for bankers, for rich people that they thought would just buy the government and create a new aristocracy in the United States. For years, there was no official lender of last resort. There was, because of Alexander Hamilton and his ideas of needing a strong central government and needing a a national bank to support infrastructure and industry. They did create what they call the First National Bank of the U.S., which was kind of like a central bank, sort of like a central bank, not really a central bank. They were able to act as lender of last resort a little bit, but not too much. They basically helped keep some stability in the banking system, but mostly were able to loan money to the government. There wasn't a lot of support for it. Like common people didn't like it, so representatives weren't going to run on supporting the First National Bank. So when its charter ran out, it ceased to be the national bank and became, I used to know the name. It was like the First National Bank of Philly or something like that. And that bank lasted as a state chartered bank until the saving and loans crisis in the 80s. We went without a central bank for years until after the War of 1812. During the War of 1812, government needed to borrow money, had no one to borrow money from. So I had to issue bonds to people. There was no bank to do it, to make it orderly. Because of how difficult it was to raise funds to fight that war, they were inspired. Some leading politicians and some leading bankers got together and to design the Second National Bank of the U.S. That lasted for maybe 15, 20 years until Andrew Jackson becomes president. And he hated the bank, hated money interests. He was the first populist president in the United States that had broad Democratic support. He came from the backwoods in Tennessee, whatever. One day he was talking to his vice president, Martin Van Buren, and he was crazy muggy in DC that day, like it is all summer. And he said, "The bank is trying to kill me, but I'm going to kill it." And he vetoed, and yeah, I think Congress passed it, but he vetoed the charter of the second bank to extend it, so it dies. Immediately afterwards, there's a recession, which they blamed on Martin Van Buren, who had become president at that time, instead of getting rid of the Second National Bank. So then we had no lender of last resort, no central bank until 1913. We'd have banking panics on a regular basis. Again, this is something that they really dive into in Money Free and Unfree. Of issues with not having a lender of last resort or other problems that are inherent in the banking industry. One of them being that banks couldn't open up a second branch, so they were not well diversified. So they were much more prone to bank runs. Excuse me. In the panic in 1907, this was particularly bad. Interbank lending clearly ceased, and J.P. Morgan, who was still alive then, was so rich and had so much money, his bank had so much money, that he acted as lender of last resort for the entire banking system. Had he not been there, the panic would have been even worse. Due to that and the inherent fragility of the banking system, several, again, prominent bankers and politicians got together and passed the Federal Reserve in 1913. There was about, I think, 6 of them that snuck down on a train to Jekyll Island, Georgia, pretending they were going on a hunting trip, and they sat down there and designed the Federal Reserve, which is why some people call it the creature from Jekyll Island. And even if you could be the biggest fan of the Federal Reserve, or you hate the Federal Reserve, and the nickname fits, because, like I said, there's no other central bank that looks like the Federal Reserve.
Should that be the title of our PowerPoint?
That should not be the title of the PowerPoint. That's like Jeff Ford saying we should reinstitute the gold standard, the Fed Challenge ones. They'd messed up and they knew they were going to lose. So at the end, he said, the hell with it. We're going to go on a blaze of glory. The Federal Reserve has an elaborate system of checks and balances. Less so now than back in 1913. And it's very decentralized. Again, as opposed to the Bank of England, which is the second oldest central bank in the world. It is incredibly centralized. It's just literally one bank that's in control of everything. This is built from the bottom up, or try to be designed from the bottom up. So they wanted to diffuse power along regional lines. They wanted to split it up between the private sector and the government, and among bankers, business people, and the general public. So they wanted everyone to be able to have input to select the leaders, to help design the Fed policy. I should note, when the Federal Reserve first began, they didn't conduct what we call open market operations, which is buying and selling of short-term bonds to influence the interest rate. They only really used reserve requirements as their policy tool. And they discovered open market operations worked a couple decades later by accident. If you ever think this stuff is too hard, the Fed discovered their policy tool by accident. But don't feel bad. So this initial diffusion of powers, like throughout the system, resulted in the evolution of the Federal Reserve System to include several of the following entities. There's Federal Reserve banks, the Board of Governors of the Federal Reserve System, the Federal Open Markets Committee, the Federal Advisory Council, and there's around 2,900 member commercial banks. Not all banks are required to be members of the Federal Reserve System. But since the 1980s, all banks, or virtually all banks, are required to adhere to the reserve requirements and, something else. So they're all basically controlled by the Federal Reserve. That's how the Fed works. Looks easy, right? So you've got the Board of Governors, who are involved with reserve requirements, which is one of the policy tools. That they require banks to keep a certain amount of capital on hand, a certain percentage of all the loans they give out. They also review and help determine the discount rate, which is the rate at which the Federal Reserve lends to financial institutions. When banks take advantage of this, it's called going to the discount window. They don't literally go up to like the teller window at the Federal Reserve, at least anymore. That's very rare and is only used in crises because, especially since, I think since the saving loans crisis in the 80s, if a bank goes to the discount window, that means they can't get a loan from other banks, which is a sign that their collapse is imminent, that they're insolvent and they're seriously struggling. So any bank that does that in like a normal time, it's seen as a sign of weakness. People start shorting their stock or selling it, and they'll suffer for it. And we have the Federal Open Market Committee, the FOMC. That's the 7 members of the Board of Governors, and the president of the Federal Reserve Bank of New York, and 4 other regional banks that serve on like a rotating basis. They direct open market operations, which is the Fed minutes that are coming out. That's from the FOMC. So when people say the Fed, that's who they're normally talking about. They determine what the open market operations are going to be, how many bonds to buy or sell in order to influence the interest rate in the way that they want it to go. I don't know what else. Yeah, the reason why the Federal Reserve Bank of New York is always on it is they're the ones that actually do the buying and selling of the bonds. So, and New York is the most important financial center in the United States. The 12 Federal Reserve banks. So we're in the Bank of Philly region. There's Boston, Richmond, Cleveland, Atlanta, St. Francis, there's a bunch of them. They have 9 directors. 6 of them appoint the president of the bank and other officers of the Federal Reserve Bank. They establish the discount rate in their bank region. The member banks, the commercial banks in the Federal Reserve System, they vote to elect some of the directors of each Federal Reserve Bank. And then there's a Federal Advisory Council with 12 members from each district. Again, a very, very diffused, confusing structure, which was designed to include checks and balances to make sure everyone had a say in the Federal Reserve. I would say quasi-public institution, so it's not entirely government run. It's partially owned by private commercial banks in the districts that are members of the Federal Reserve System. The Federal Reserve issues stock to them and can pay no more than 6% dividends on it. So the Federal Reserve banks, member banks, like I said, 6 directors for each district, and then 3 more are appointed by the Board of Governors. So those are the ones that are nominated by the president. That's coming up next. I'll give more details on that. So 3 of the directors are professional bankers. They come from the industry. 3 more are prominent leaders from industry, labor, agriculture, or the consumer sector. The makeup of like where they come from are going to be different based off of what region you're in. So like the Cleveland region is going to be more like heavy industry and labor, and I don't know, what's the one tech? I think Dallas is going to be more agriculture. Then finally, there's 3 directors that are appointed by the Board of Governors, and they're not allowed to like work for banks at all. So they're supposed to like reflect the public. And then the 9 directors appoint the president of the bank, and that's subject to approval by the Board of Governors, because 5 of them are going to be serving on the FOMC with the Board of Governors. Here's a breakdown of the Federal Reserve System. Like I mentioned before, Missouri was a swing vote. So the state of Missouri gets 2 Federal Reserve branches in the city and St. Louis. You can tell it was designed in 1913 because California is in with like 6 other states. They designed it now. California probably broken into 2 and get 2 Federal Reserve regions. And Cleveland, Cincinnati, Louisville, they would be in Pennsylvania. So different cities that have Federal Reserve branches that and they conduct research. They're involved with, I don't know, like check clearing, that kind of stuff, the actual like maintenance of the banking industry. Maybe get involved in regulatory oversight. So like in the Richmond district, Charlotte, they do a lot of banking oversight because there's a lot of banks down in Charlotte. So their function is to establish the discount rate. And they also determine which banks can use the discount window. It's not just open to all banks. I'm not sure what the current regulation is deciding who can and who cannot do it, but your typical commercial banks can all do it, can all use the discount window. I think it was George Selgin has suggested switching to flexible open market operations and a flexible discount window. So allowing any financial institution or any, even like, firm related to the financial industry. So like AIG, like an insurance company, if they needed, could use the discount window. But currently it's restricted, and that's determined by the Federal Reserve Bank directors for each region. 5 of them serve on the FOMC, like I said, New York Fed always there, and the other ones on a rotating basis. So at one point, during the recovery from the financial crisis, the Philly president, now his name's escaping me, Charles Plosser, super big inflation hawk. We had like 1% inflation. He's like, we need to raise interest rates now because inflation's about to get out of control. Never did. But that was his concern. He would, rail against it all the time. Finally got on the board and would vote to raise interest rates immediately. It was like the dissenting voice, the only one to do it. But he was only on there like 1 year, floats back off. Has to wait another couple years to get back on. So now the Federal Reserve branches, they clear checks. So checks like banks, I guess from one bank to another bank has to go through the Federal Reserve branch. They issue new currency. So if currency gets too worn, I don't know, if banks just need more money to put out, they give them the new piece of the currency. They withdraw the damaged currency from circulation. They administer and actually make the discount loans to the banks in their districts. So it's not like the FOMC, not the Fed in DC that's doing it, it's the regional feds that give the banks those loans in emergencies. And they evaluate proposed mergers and applications for banks to expand their activities. Like I said, the financial industry and banking is heavily regulated. So they still have a strong role in controlling what banks do. They act as liaisons between the business community and between the Federal Reserve System, so they kind of represent their interests because they're made up of some people from the public and the business community.
So are like coins a different type of currency than Federal Reserve notes? 'Cause don't coins come from the US Mint, which is part of the Treasury?
Well, the bills come from the Treasury too.
They do?
Yeah, it's like the Federal Reserve that actually gives them to the bank. Yeah, like the Secretary of the Treasurer signs each bill. That's all I see is the signature of the Secretary of the Treasury. But if you notice on the ones, they still have, I wish I had a dollar on there.
Which mint they come from?
It has what Federal Reserve branch they come from, and the little seal there.
Throw
That's
your
the
little
lettering.
thing.
Oh, yeah.
We have the technology.
Hey, some your fault. It'd be great.
Dramatic pause. There we go. Got extra cash on me today. So right here, it says C, the Federal Reserve Branch of Philadelphia, Pennsylvania. So you know exactly which branch it comes from. Wow, also I have a 5 today. This is like the most money I've had in a long time. $5 bills just have Federal Reserve System. Doesn't say where it comes from anymore. But if you find like an old one with like the small heads on them, they'll say what branch it came from. I'm not sure who actually issues the coins. I assume it'd be the Fed as well. That it's just like their job to put the currency out. There used to be a very close relationship between the Federal Reserve and the Treasury. At one point, the Secretary of the Treasury was always on the FOMC. Wasn't FOMC? I know it was the FOMC. I think the Board of Directors or Board of Governors is like how they're on the FOMC. And the Treasury basically dominated the Federal Reserve for the first like 40 or 50 years of the Fed. Then they signed in the 60s like the Fed Treasury Accord, which basically separated the two of them, made the Federal Reserve more independent. So they have a strong relationship and work together, and their functions kind of overlap in several ways. They examine bank holding companies and state chartered member banks. That's part of their regulatory authority. Now, especially since the recession, stress testing is a huge function of the Federal Reserve. Actually go through banks' assets and see how exposed they are to risk and if they could withstand a negative shock. And they do a ton of different shocks.
Did a bank just fail stress test, the big bank over the summer?
Probably. The big banks, the first like 2 or 3 years, like failed.
It was a big deal to say. Didn't happen to us from the bank.
They like dramatically like reduced like the numbers that they had to have from when they did it initially like after the crisis.
That's not surprising.
Yeah.
Also, another question, kind of related, kind of unrelated, more related to the challenge. For next Tuesday, could you see if, well, I don't remember, sorry. Could you see if you could get the scorecard from Gibbons?
Yeah. I don't have anything right now. Yes.
You didn't,
I have that somewhere in my emails. If I can dig it out.
sorry.
Well, we've been talking for a while. I was packing up my office and I saw this picture I have. I went to a conference, like a week-long conference in Italy for like young economists, like 2 years ago. It was all paid for. It was awesome. Got a picture with John Roll, who was a Nobel laureate in 2004, and we had they gave us like a little, not even a plaque, just like a piece of paper, a certificate saying like, congratulations, you were here. And each of us like had a picture with him like presenting it to us. But for mine, for some reason, he held it like this. So it looks like he's flicking me off in the picture.
That's awesome.
So I can say I got flicked off by a Nobel laureate. I mean, not a lot of people can say that.
Well, handing you a certificate.
But I got it on photograph too. That's why they gave us like a printout of it, like at like the dinner the final night. This was like the night before that we got the certificate. And like they sat down next to me and everyone looks at it and just starts busting out laughing. I'm like, what's so funny? I looked down. Oh my. Yes, and the most important thing that the Federal Reserve banks do is collect data on local business conditions. And their staffs and professional economists research topics related to monetary policy. A lot of data we get comes from the Federal Reserve. Again, if you're on the Fed Challenge Team, the Federal Reserve Bank of Dallas puts out all these awesome employment statistics, breaking it down, like I mentioned, like job turnovers,
Does Fred have a subject?
job openings. It might be in Fred. The 1 year I just took them straight from the Dallas Fed's presentation.
Okay,
They talk about consumer confidence.
okay.
The most important thing is wages. Look at if you're experiencing wage growth, if it's just starting to take off, inflation's coming down the road a little bit. Because as labor costs increase, the price of goods are going to increase. All right, the Federal Reserve Bank and monetary policy. Directors establish the discount rate, so they actually set the interest rate at which they loan to banks in emergencies, and they decide which banks can obtain those discount loans. They select one commercial banker from each district to serve on the Federal Advisory Council, which consults with the Board of Governors and provides them with information to help them decide what to do with monetary policy. So you can see there's a lot of influence from the regional banks and from the member banks, like the private commercial banks, in helping develop monetary policy. You can see how they could have a lot of control, or you can see how the FOMC could just basically ignore or just like thank them for the information and then decide what they want to do. You look at Fed history, Greenspan would have everyone in the room, like everyone on the FOMC, like say what they thought the state of the economy was, what they should do. Then he would summarize it and say, okay, now this is what we're going to do. And there were times that everyone else in the room disagreed with him, but he said, no, we're gonna cut interest rates anyway. It worked out. He engineered the only what they call soft landing. So GDP was growing, but we were seeing more inflation. So there was a threat that the economy was overheating, that there would be malinvestments due to what some people call irrational exuberance, belief, like in the housing crisis, prices are going to just keep going up. Things are going to keep getting better. People take more risks because they're chasing yield as inflation increases. So he put the brakes on a little bit. Some people say that the job of the Federal Reserve is to take away the punch bowl right when the party gets going, to make sure things don't get out of control. That was a different time because at that time he raised interest rates when people didn't want to raise interest rates. Especially people like Fed watchers, people outside of the FOMC, didn't want them to raise interest rates. He did. Lowered inflation, lowered GDP growth, increased unemployment a little bit, but it was very smooth and then kept growing again. He termed it the soft landing. That's the goal of what the Federal Reserve does when growth gets too high. So the financial press called him the maestro because he was like conducting an orchestra, able to influence all those things. The time he cut interest rates instead of raising was also considered a big victory, that he was correct and everyone else in the FOMC was wrong. So, but basically what I want to say was member banks, the region, Federal Reserve like regions, can't have a lot of influence on the Federal Reserve. They can have next to no influence on the Federal Reserve. Okay, so all national banks are required to be a member of the Federal Reserve System. National banks during the Civil War were required to hold the fiat currency called greenbacks. The first fiat currency issued by the government. They were giant, like that big, but they were green colored bills, so they got the nickname greenbacks. Their reserves are required to be 100% of like the assets that they loaned out, and it had to be held in greenbacks, which caused very serious problems with the elasticity of the money supply. A lot of people wanted currency. The bank had to, well, they couldn't call it. They'd have to like write a letter or send a telegraph to the Treasury and get more bills. So it'd take a long time if there was a sudden influx in demand. So they were all required to be a member of the Federal Reserve System initially. State chartered banks were not required. They could choose to be members if they wanted to or not. Up into like the 50s, membership peaked on the Federal Reserve System and then declined sharply, especially in the 60s and 70s as inflation began to increase. Banks, the certain requirements that the Federal Reserve had for member banks became too onerous. They could make a lot more money instead of holding, that Federal Reserve stock that paid 6% dividends. They could invest that in other assets that paid higher interest because, you pay 6% interest, but inflation's 6%. You're not making anything in real terms. So they'd have to chase higher yield in order to make money. So in order to counteract this, in 1980, Congress passed the Depository Institutions Deregulation and Monetary Control Act. Back then, they didn't use snappy titles like they do now, like the Jobs Act or something. And it required all banks to have the same reserve requirements as member banks and gave all banks access to the Federal Reserve facility, so like the discount window. Basically increasing the Federal Reserve's power and their influence over the financial industry, that their policy tools could be more effective because all banks had to rely on the reserve requirements. Discount window now affects everyone, which is especially useful in crises when banks are failing and need money, can't get loans from other banks. And to wrap up today, the Board of Governors of the Federal Reserve System, there's 7 members that are headquartered in Washington, D.C. They're appointed by the President and confirmed by the Senate, just like any other presidential appointment. They serve one 14-year term. They cannot be renewed. William McChesney Martin, back in the 60s, well, back like 50s, 60s, early 70s or something, he stepped down in year 13 and then was renominated. So he got to serve for a long time, but people haven't done that since. Oftentimes they leave before the end of their 14-year term because if you're that highly regarded of a macroeconomist with a PhD, you can make a ton more money and have a much easier life in academia or make even more money working in private industry. Greenspan worked for basically like a Fed watching firm that he was like a partner in and made a ton of money before going to the Federal Reserve. The members are required to come from different districts, so they have to, in theory, represent different parts of the country or understand the concerns of those parts of the country. Again, fear of centralized power, so try to spread it out as much as possible. And the chairman is chosen from the governors and serves a 4-year term. At the end of their chairmanship, they usually step down. So even if the 14 years aren't up, well, obviously because 14 isn't divisible by 4. The end of their term, they step down. So Janet Yellen still had time to serve on the FOMC, but when she was done with her term, she was not selected. A couple years ago, she stepped down from the Federal Reserve Board, or from the FOMC, Board of Governors. And with that, it's 8:50, so we'll end class.